Well, I've been reflecting on the cross-border mid-market M&A compass for 2012, looking back over the 2025 year, which was prepared by Moores Global Corporate Finance and also Lyric University. And what stands out for me is that it's not simply another M&A report. It's really a signal about how companies are thinking about growth, resilience, and their strategic repositioning in this fragmented world. Um, what we see from the M&A, or what we saw from M&A, and this comes from some earlier posts as well, is the rebound in 2025. But I think what's most interesting sits beneath that headline. Larger deals may attract a lot of the attention, but the mid market really remains the real engine room for growth, deal activity, and this in emerging markets and in the developed market. So if we look at the report, mid-market deal making accounted for 53% of global transactions in 2025. And what's further interesting is broader um, mid-market deals represented 39% of all mid-market transactions. And that matters because it tells us that international expansion is no longer only for large cap uh, companies, mid-sized companies, private equity investors, strategic buyers, founder-led businesses are increasingly using cross-border M&A to access new markets, acquire capabilities, secure technology, and really building resilience. So what we see from this report is that broader M&A really grew faster than domestic M&A in the 2025 year. And cross-border activity increased by around 18% compared to 11% for your domestic transactions. And in this cross-border mid-market specifically, transactions volumes were up about 17%. Globally, this is about just over 4,000 deals. So despite all the geopolitical tensions, the trade disruptions, inflationary pressure, and obviously the more cautious financial environment, companies are still looking beyond their home markets. In fact, in many cases, they're doing so because of that uncertainty. So that's the first leadership point for me. In a fragmented world, growth cannot only be organic, local, and incremental. Businesses need optionality. They need access to new customers, new capabilities, new supply chains, new technologies, and new pools of talent. So your cross-border M&A, of course, done well, is one way to create that optionality. But of course, the phrase "done well" is doing a lot of the work here. As we saw in the report points to a more selective environment going into 2026. The report also notes strong mid-year surge in announced deals, followed by more measured towards the end of the year. So we already saw a bit of a down tuning, and I think this is carrying through into 2026 now, with Q1 results also showing a little bit of a pullback just with the geopolitical tensions. But this tells us that we saw confidence returning, but it's definitely not blind confidence. Deal makers are much more disciplined. They're more careful around valuations. They're more sensitive to financing conditions, geopolitical exposure, regulatory scrutiny, which has been a theme for the last 3 years, and of course, then execution risk. How do we actually close the deal, but how do we also integrate? So the message for boards and executives is not go and do deals. The message is be very strategically prepared to do deal making. The businesses that will benefit from this environment will not be those that simply react when asset prices uh, appears well priced in the market. They will be the businesses that have already done the strategic work. They will know which market matters, which capabilities they lack, which assets they would like to own, which partnerships make sense, and where M&A fits within this broader strategic architecture of the organization. And I think this is where, if you bring a strategic lens into it, it becomes so important. Good strategy is not a wish list. It's not simply growth ambition. It's a clear set of choices about where to play, how to win, what capabilities are needed, who needs to be involved, and how the organization must align behind all those choices. So for me, what's highlighted through this report, there's five key themes that really stand out. The first theme is structural resilience in this middle market. The mid market continues to be the backbone of deal making. It's large enough to matter, but often small enough to move with focus and speed. So for companies, this means that your mid-market M&A can be a very practical route for growth. It can be used to enter geography, acquire technical capabilities, deepen customer density, consolidate a fragmented niche, or accelerate a business model or a business model shift. I think the second key theme is the dominance of North America and Europe. North America and Europe remain centers of gravity for cross-border mid-market M&A. North American acquirers accounted for 45% of acquirers of deal count. Europe accounted for 30%. So North America also became an increasingly attractive target region, particularly because of the investors' interest in AI and assets, which again isn't a new trend really. North America's always been a big for the private markets. But this matters because it reinforces a very important point. Capital is following capability. So investors are not just buying geographic locations, but they're buying technology, intellectual property, data, talent, platforms, and market access. The third theme that stands out is sector concentration. Interestingly, here it probably won't be new to many, but IT, healthcare together accounted for about 53% of global cross-border mid-market transactions. IT alone accounted for 39%, healthcare 14%. And again, these are not random sectors. They are sectors where scale, data, regulation, innovation, and capabilities all matter. A fourth theme is probably a subsector of IT, but is AI. North America dominated AI-related cross-border mid-market M&A. Both as an acquirer and as a target region. This is important because AI is no longer just a technology theme. It's now a very strategic capability theme. So companies are asking, do we build, do we buy, do we partner? And in many cases, the answer is increasingly to buy this capability, or at least acquire access to it through a minority stake or partnerships or venture investment or very targeted M&A. Of course, a lot of complexity comes with this, but this is the theme that has emerged. And then the fifth theme is sustainability. What we see from the report is that sustainability as an explicit deal driver remains relatively modest in mid-market, but its strategic relevance is growing. In cross-border mid-market deals, sustainability-related rationale rose from 2% in 2020 to about 7% last year. 7% in 2024 and then 5% in 2025. Europe and particularly the EU stands out as centers of gravity for sustainability-related M&A. And again, I read this not as a sign that sustainability is fading, but as evidence that sustainability is becoming embedded into the broader strategic logic. So it's no longer always labeled as ESG. It may appear as energy transition, supply chain resilience, regulatory readiness, access to green technology, circular economy capabilities, or just customer licenses and societal license to operate. So again, interesting to just notice how this seems playing out. Now, based on this context, as always, what should businesses and what should the executive and board members be thinking of? Well, I think if we look at these trends from M&A, the first thing business should do is to clarify the strategic rationale before they start looking at targets. And again, surprisingly, this is not always the case. We often know that M&A is pursued opportunistically or then backed with ego as opposed to a true strategic rationale. And the report also identifies three leading rationales behind cross-border M&A, which is enterprise industrialization and maturity acceleration, proprietary assets and intellectual capital acquisition, and then territorial market entry. And together, these three account for more than 70% of all deal motivations. And this is a powerful insight. So again, going from enterprise industrialization and maturity acceleration looking at proprietary assets and intellectual capital acquisition, and then territorial market end-to-end density. And again, this is powerful insight. This tells us that deals are not primarily about financial engineering, but they are about capability, scale, knowledge, market assets, and acceleration. So boards should be asking themselves, what is the strategic problem we are trying to solve? Now, incidentally, what's quite interesting when you start looking at AI as well, when you start looking at if you start looking at we need to onboard certain capabilities, well, the question you actually have to ask is what problem are we trying to solve, and that's where the investigation actually starts, not by looking at the solution first. And here we're seeing a very similar trend evolve. Or should ask, what is the strategic problem we're trying to solve? Are we trying to enter a new market? Are we trying to acquire technology? Are we trying to accelerate maturity? Are we trying to secure supply? Are we trying to build density in a fragmented market? Are we trying to transform our business model? Because again, if the rationale is not clear, the deal should not proceed. I think a second thing that business should consider is to build cross-border M&A thesis um, before they actually need one. So again, this is about preparedness, and this is essentially important, especially important for mid-market companies. Too often, M&A is opportunistic. A target appears, advisor circulates a teaser, management gets excited, and the deal process starts before the strategic logic has been properly tested. A much better approach is to develop a strategic M&A map, which geographical locations are priority, which sectors or subsectors matter, which capabilities are scarce, which regulatory environments are attractive or risky, which competitors are consolidating, which assets would be genuinely strengthen the business, which markets should be avoided. And this is where scenario planning becomes very useful. Something we've seen through um, if we look at scenario planning, um, leaders should not simply forecast one future. They should test and move against multiple plausible futures. And while kind of asking questions, what happens if trade barriers increase? What happens if rates stay higher for longer? What happens if AI adoption accelerates? What happens if regulatory regimes tighten? What happens if energy costs reshape industrial competitiveness? So taking a scenario planning approach and making decisions in the now to best prepare yourself also gives you that optionality and the organizational capability to adapt. So a good acquisition should make sense across more than one future because it helps you prepare for that future. It's not only works in one narrow version of the world. That's not a strategy. That's a bet. I think the third point is that business should also focus on this from a capability perspective at the center of value creation. And we see this in the report as well. So we see strong activity in IT, healthcare, AI, intellectual capital acquisitions. And this means leaders must look beyond revenue and EBITDA. In many cross-border deals, the real value sits in people, data, systems, know-how, patents, customer relations, regulatory licenses, or platform potential. So it's really about this capability build as opposed to simply just a revenue number or EBITDA number or margin improvement, um, which changes the due diligence landscape a lot. Due diligence cannot only be financial, legal, and tax. It must be strategic, operational, cultural, technology, and governance led as well. Leaders need to ask, what capabilities are we actually buying? Is it transferable? Is it dependent on a few individuals? Can we retrain the talent? Can we integrate the technology? Can we scale the platform? Are there data, cyber, regulatory risks? Does the target and culture support the value creation plan? Very important questions to ask, and not always the focus of what we would traditionally necessarily look at. The fourth thing businesses should do is to bring governance into the deal process quite early. Governance is often treated as a post-deal issue, and of course this is a mistake. In cross-border M&A, governance should shape target selection, deal structure, due diligence, risk appetite, the integration plan, and the post-deal accountability. So boards should be asking much more rigorous questions way before the approval issue, looking at, does this deal fit our purpose and strategy? Does the assumptions underpin the valuation? What risk could destroy value? What is the integration thesis? Who owns the delivery after close? What capabilities must be protected? What decisions need to be made in the first 100 days? What will measure success, and what would cause us to walk away? So good governance is not about slowing deals down. It's about improving the quality of our strategic judgment. A fifth theme, or for business to consider, um, is to do a planned integration before signing, not after closing. And this is where many deals fail. I also talk about this in a separate or earlier post where I talk about M&A success factors. But the financial model assumes certain synergies, cross-selling, operation improvement, capability transfer, but those benefits do not realize themselves. They require implementation, and they require alignment. So purpose must align with strategy, strategy must align with structure, structure must align with culture, and culture must align with incentives. And incentives, of course, align with governance, and governance must align with your execution. And that is the strategic point around the alignment thesis as well. So in cross-border deal, alignment is even harder because you're not only integrating systems and reporting lines, but you're integrating national cultures, regulatory environments, leadership styles, customer expectations, and operational rhythms. So businesses need an integration design, not just an integration checklist. What should we be integrating quickly? What should we be protecting? What should remain local? Where do we need common standards? Where do we need local autonomy? Which leaders are critical? What's the narrative to employees, customers, regulators, and investors? Of course, business should also do more disciplined valuation. Again, if we look at the report, M&A, the recovery in an M&A market can create pressure to move quickly. AI, healthcare, high growth technology assets can attract competitive processes and premiums, but strategic importance does not remove the need for financial discipline. So boards and investment committees should separate strategic attractiveness from pricing discipline. So a good asset can still be a bad deal at the wrong price. A strategic narrative acquisition can still destroy value because of integration risk, retention risk, regulatory risk, execution complexity, if that is underestimated. So the question is not simply can we afford it? The better question is, can we own it? Can we own it better than the current owners? Can we create value after paying the fair price for that risk? The seventh business consideration is to treat sustainability and regulation as part of the commercial strategy. What we see from the reports, sustainability data is increasingly relevant for companies looking into Europe. The EU is a major hub for sustainability-related M&A, and this means that companies acquiring into or from Europe need to understand CSRD, supply chain due diligence, taxonomy alignment, climate disclosure, assurement expectations, and broader stakeholder scrutiny. And this is not only a compliance issue. It affects valuation, access to capital, customer relations, procurement eligibility, and long-term competitiveness. So for African and emerging market companies, this is especially important. So cross-border M&A can be a route into global markets, but it also exposes the business to higher regulatory and reporting expectations. So leaders need to ask whether the organization has the governance system, sustainability data, risk control, and reporting maturity to really operate in with credibility in these markets. I think the final point, as always, comes down to leadership. So cross-border M&A is ultimately a leadership test that tests the judgment, discipline, humility, and execution. It requires leaders to hold two ideas at once: ambition and caution. Ambition because the companies cannot stand still. The report makes it clear that businesses are using M&A to access technology, accelerate maturity, and enter new markets in a world being reshaped by AI, energy transition, regulation, and geopolitical fragmentation. Waiting may be the biggest risk, but of course, on the other side, caution as well. Not every deal creates value. Complexity is real, integration is hard, cultural misalignment is expensive, overpaying is easy, and strategic drift often hides behind the language of growth. So my message to business leaders is this: don't just read this report as a call to chase deals. Read it as a call to become deal ready. Um, Deal ready means having a clear strategy, knowing which capabilities matter, which you have, which you may need to acquire or develop, understand which markets are strategic and relevant, having governance that can challenge assumptions, having leaders who can integrate cross border, being financially disciplined, and building organizational alignment before, during, and after the transaction. So cross-border mid-market is resilient because it sits at this intersection of ambition and practicality, but there's always this not it's not always the mega deals catching the headlines. They're often the focus, but they're often focused strategic capability building transactions. Done well, they can help companies internationalize, transform, and compete. But here too, the winners, the ones who transfer and create value, will be those who understand that M&A is not the strategy. M&A is the tool of strategy. And in 2026, as the year progresses, that distinction will matter more than ever. I've also going to attach the report that I've based a lot of some of these insights on. So please have a look at that. But hope you find my input valuable.